Good morning and happy Friday, everybody. This is Steve Clemens, Vice President of Life Markets here at URL. Thank you for joining me this morning for our April edition of our First Friday Life Markets Marketing Minutes meeting. And this morning, we have a couple ideas to share with you, one on a term idea and then the other more on a permanent solution idea. Before we do get started, I wanted to direct everybody to the handouts. I generally try to provide a couple handouts for each of these meetings for those on the line. We have a one-page handout of our Life Markets department, extensions, email addresses of who to call when you have a specific life insurance case you need help and support on. Secondly, we provided 2 additional handouts this morning. One on a life insurance checkup guide. So if you are meeting with a client, an existing client or new client who has life insurance or maybe doesn't, but if they do, it's a checkup on their existing coverages and their life insurance needs. And then the last one is a product portfolio for Protective Life. The 2 sales ideas we have today come to us from Protective Life. So to get started, we are going to go through a couple ideas on what we call stepping up your game with Protective Life. We have some step up premium ideas that may be useful for some of your clients. If you're not familiar with Protective Life, the financial ratings are here. We've worked with Protective Life for many years at URL, and many of the companies that they have acquired over the years as well, like Zurich Kemper, Zurich Life, West Coast Life, and more. So we're going to start today with some of the short-term stepping up solutions and ideas. And with Protective Life, for short duration products, they have what's called the Custom Choice Term UL product, as well as the Classic Choice Term. So the Term UL is, for those of you who've been selling term for a number of years, you may remember a few carriers used to have a Term UL product. It's built like a term, but on a UL chassis. And that's what this is. It has a duration of 10, 15, 20, 25, and 30 years, just like the traditional term product. Generally speaking, you're going to see very competitive pricing on this with the term and with all the term carriers in the marketplace. Its convertibility is up to for 20 years or age 70, whichever is sooner. So that doesn't matter if that's a 10 or a 30-year plan. It's to age 70 or 20 years, whichever the sooner of the 2 is. And you have true flexibility on this. And remember, you have term pricing, but flexibility of a permanent policy. So you can actually single pay a 10-year plan on this. You can short pay it, step up pay, and also it accepts 1035 exchanges, which is pretty unique. And then you have the traditional term for, again, 10, 15, 20, 25, and 30-year level. And then you have convertibility to GUL in the first 5 years. And then on a 10 and 15-year term convertibility, you have until 2 years prior to the end of the term policy with this plan. And on the 20, 25, and 30-year duration, you have convertibility to year 18. So the Protective Custom Choice UL, it's ideal for your clients in their 20s to 50s, seeking affordability for income protection, mortgage expenses, and needing the flexibility for when life happens and the unexpected happens. You'll have more flexibility than you will with any traditional term product. But the real highlight that I wanted to go over today is the 5x5 example, the step up on the 5x5. So what's unique about this Custom Choice UL term? We're looking here at a 10-year term or a 10-year Custom Choice UL. And this is $1 million plan. So I'm going to highlight this here and spotlight this. You can see the major difference in this product in compared to a traditional term, even the term you would write with Protective or any other company in the marketplace, Banner, Lincoln, Prudential, AIG, et cetera, et cetera, et cetera. You have your level premium and level death benefit for whatever the length of term is, 10, 15, 20, 25, or 30 years. But the big difference is what happens with this policy after the level term period is over. Where most term policies, the premium is going to jump 10, 15, 20 plus fold what they're paying, and the death benefit will stay the same. Not the case with this product. This product will conversely keep the same premium payment each year, but as you can see, the death benefit's going to reduce every year. So we see clients liking this policy a lot on a term-like scenario because at the end of that 10, 15, 20, 25, 30-year period, it kind of sneaks up on you if you've had a term policy and you come to the end of the period and then all of a sudden you get that renewal bill notice that it's going to go up to this astronomical number. So especially clients and our families that take policies out for mortgage protection, income replacement, you know, if they've had a level death benefit now for say 20 or 25 years and they had a 30-year mortgage, well, this is a nice solution because the death benefit gradually drops, but your premium stays the same. So that's a nice feature. So something to think about when you're quoting term and you want something a little unique to show your clients. It's a nice feature. Now let's kind of get into the 5x5 scenario. Many times when we're looking at term here at URL, we'll have a agent working with us ask for a 5-year term or an annually renewable term. Well, there really aren't any competitive 5-year terms out there. And what this product is going to be able to do is you can step down actually this premium in the first 5 years to make it more competitively priced than a traditional 10-year term, and then step up the premium in years 6 through 10. So take a look at this solution here. So you're going to see here the same client for $1 million, 50-year-old male. Instead of paying $1,915 and change, we've now reduced the premium in the first 5 years to $1,529 a year. So we've reduced the premium by almost $400 in the first 5 years when this client needs it. Maybe it's for a buy-sell agreement, or maybe it's for a business loan or something for 5 years, and they don't really need to pay that higher premium over here on a traditional 10-year. So you can dial down the premium in the first 5 years, and then we have a catch-up premium years 6 through 10. So if the client then maybe wanted to keep the coverage, they would still have the ability to do so. It's going to step the premium up to $2,461 years 6 through 10 if they do need it in those years. And then if they then kept it years 11 through 15, it'll reduce back to the original premium, as you see here, the $1,915, and the death benefit will continue to reduce. So a nice little sales concept that's out there. If you have those annually renewable term needs or a 5-year term need, this is a good solution for those opportunities. And with the Protective term plan, the one nice feature about their term plan and their term UL plan is, you have a 10-year, 15, 20, 25, and 30-year level plan. What I really like on their plans is the policy fee is fully commissionable. So when we look here at URL at these very healthy, younger clients for $100,000 of coverage, $250,000 of coverage, and we're looking at monthly premiums of $15, $20, $25 a month. Small cases. When you have a company that you're working with on term that has a 60, 70, or even higher policy fee that's non-commissionable, that's a lot of money out of your pocket for doing the same work. So companies that provide a commissionable policy fee like Protective Life, especially on those lower premium cases, are something you want to consider. And it's something, please ask myself or our marketers here at URL as to which companies offer a commissionable policy fee, because there's many competitive carriers that do, along with many that do not. Okay, so that kind of concludes the term kind of step up option and step down option. Using a step premium strategy here, we're going to be looking at the permanent solutions. So this is when we have clients that may think, that life insurance is not all that affordable right now because they might be working to meet other financial goals like paying off their mortgage and building for a retirement nest egg. But there's a way for them to get coverage they need today, permanent coverage they need today, by using these step premium strategies. So in these few slides, we're going to cover the immediate needs using the step premium strategy. We're going to look at Protective's Index Choice UL using this strategy because it's going to be a tremendous product for this type of design. So again, clients concerned with protecting all of their assets and saving for retirement and wondering how they can do this. So the biggest barrier to purchasing life insurance for many is the cost of obviously the monthly premiums. When they're looking at permanent insurance, it just costs more than term. So other financial obligations, major financial goals tend to be more urgent for our clients. Again, the mortgage payment, the building the retirement funding. Growing families realize the benefits of life insurance, but the affordability of those payments kind of, again, takes the back seat, the life insurance, to some of those other financial goals. So we need to find ways to overcome some of those obstacles. So the step premium strategy kind of helps with this. We can provide a lifetime guaranteed coverage while the risk is high, protecting the mortgage and the family and everything else, the income replacement, but provide less out-of-pocket costs now and smaller premiums in the beginning. It enables your client to continue working towards their major goals of retirement planning and et cetera, while still getting that life insurance, permanent life insurance coverage they need. So on the back end, there'll be larger catch-up premiums, which can ultimately extend the coverage. Now, while we do this strategy with the Index Universal Life, you're lowering the premium on the front end of the policy, but you're not taking away from the compensation that you're earning. With Protective, they have a rolling target commissionable premium. So even though in the earlier years, your client's going to be paying less than the full target commissionable premium, you have multiple years to receive your full target commissionable premium. So many times when you do these strategies, it's almost 2 years of full commission, which is a really nice feature that Protective has. So with the STEP strategy, we can help our clients pay up to 45% less out of pocket now for permanent protection with a larger catch-up payment later on. So that's going to maximize the internal rate of return on the death benefit through life expectancy. So our clients who can benefit from these strategies are pretty vast. Again, all of the things I've talked about here is families working to pay off the mortgage and the retirement planning, but also you know, they're going to be, as they're putting more money into the retirement planning, they're going to have RMDs to take out later. So we're going to show you how you can utilize a portion of those RMDs, those required minimum distributions on the retirement planning solutions, as to help with the step-up premium. So the level premium strategy, if we were just to quote a level premium for whatever the need is, you're going to have a consistent payment throughout. So obviously for those clients, it's going to be more out-of-pocket premiums up front. So if your clients are comfortable with that, then it's a great solution. Then it's just kind of consistent premiums, and if they're very comfortable with it, that's great. But not everybody is. So that's why we look at the step premium strategy, giving your clients more flexibility, less out-of-pocket up front due to budget constraints. So again, this is a great product, the Index Choice UL, for using this strategy. It does provide on the Index UL, you have a guaranteed death benefit option, inexpensive policy fees, and charges drive strong accumulation on this product. And they really do deliver on what is promised in this plan. So a unique feature with these step premiums is whether it's on that term UL or the UL strategy, whatever the premium is that you put in that illustration. So if you did the 5x5 on the term UL plan, and you had the lower premiums in the first 5 years, and then the step up years 6 through 10, if that's in that illustration, Protective recognizes that, and then in the 6th year, they make that adjustment for you and your client. You don't have to remember 5 years down the line that, oh, I forgot my client needs a step up premium. They already have that for you, so they're delivering on what's promised there. Same on the UL with these step ups. If you're doing a step up in year 25, it remembers that. They put that in their system from the illustration to put that step up premium in. Because many of us in 25 years, we may not be there at that time for our clients. We may be retired. We may be 6 feet under. We're not going to be there, but Protective is going to deliver on that promise. So this step-up strategy is best suited for ages 65 and younger, particularly mid-40s to 50s, folks with a conservative to moderate and risk temperament, and interested in guarantees. So let's take a quick peek at a couple different options here. So here's, we're going to go through with Tim here, 45 male, married, 2 kids, $250,000 mortgage, 30-year fixed interest rate at 4.5. He wants coverage while paying the mortgage. We're going to use a step premium strategy on the indexed UL, and the premium will increase once the mortgage is paid off. So as we look here, I'll highlight this for everybody. He purchases the IUL and pays $122 and change a month, along with his mortgage payment. So he's 45. This is his monthly premium for his life insurance. He has just shy of, he has $1,267 of a mortgage payment. So combined, it's $1,389. So 45 to 75. After he pays off his mortgage, he steps up his life insurance premium. He uses part of his mortgage budget to help pay the increased monthly premium. So if you started with the low premium for the first 30, and then you step up, the premium goes up to $970 a month in the step up premium, but you have 0 mortgage payment. So that would then extend the death benefit guarantee to 105. Now, without the step-up premium, if he just continued to pay $122.19, his policy is actually going to extend to age 80. So it will actually go past the mortgage period for another 5 years. And then also, with that being said, he has the flexibility because it is a permanent solution. So if here he had $250,000 from age 45 to 75, and he kept the $250,000, again, it would be guaranteed to 80. Maybe he wants to step up premium. He doesn't want to step up to $970 a month and $250,000, but he will step up and still continue some life insurance. He's age 75, still needs some coverage. Maybe he decides to drop the coverage down to $150,000 or $100,000 of life insurance. So that step up premium on the back end won't be as large. So again, the flexibility in that kind of design. So here's an idea of offsetting the cost of life insurance while using a portion of the required minimum distributions from his retirement planning. So this is another 45-year-old Alex. He's got an IRA balance of $1 million at that time with an RMD of just over $37,000. He wants lifetime coverage while contributing to his IRA. He has a step premium strategy using this IUL product with Protective once again. And the premiums increase once he begins to take out his required minimum distributions at age 70 and a half. So here we're looking at his life insurance coverage with an annual premium of $2,837.48 a year. So we're looking at that from age 45 to age 70 and a half. And then we're looking, he's going to be starting to get his required minimum distributions out of $37,736. He uses a portion of his RMD to step up his premium payment on his life insurance plan to $16,500 a year, which will guarantee the death benefit to $105,000. So in his RMD, he pays $16,500 for the life insurance, leaving him a $21,236 surplus from that RMD. And again, if he decided not to step up his premium and not to reduce his life insurance coverage, this policy at this same premium would run him to age 80. So to quickly recap, solving immediate coverage needs with step premium strategies. You know, if your clients are unable to make that larger premium payment now, they can benefit from this step premium strategy, increasing the premiums once they have more access to funds as they get older. And it could be a perfect solution for your clients in those particular options. And if you need some help in that design and you have a client that comes to mind that may benefit from this, reach out to us at URL. We'll be happy to help you with those strategies and help you along in that process. That concludes today's presentation. If you have any questions, please certainly put them in the question box down below, and we'll be happy to answer any questions you have. If you don't have any questions, thank you for dialing in today, being with us here at URL, and on your next case, please give us a call. Don't forget about the handouts in the bar for the Life Markets Department, the Life Checkup Guide for Protective, and the Protective Product Portfolio. Again, thank you all for being on the call today. And if you have any questions, I will answer them now. Oh, just have a thank you from Michael. You're welcome, Michael. Thank you for being on the call today. And that concludes it, everybody. I hope you have a great day, great weekend. I will be in the office for another 2 hours today, so if you do have any questions, please give me a call at at URL. Our toll-free line is 800-926-8875, and my direct extension is 132. Bye for now.